Hello and welcome to Livewire Markets Views from the Top. I'm Ali Selby and today we're joined by Ely Griffiths Group's David Allingham for a look in at the company's new mid-cap strategy. Thank you so much for joining me today, David. I'm really excited for this chat. Obviously, Ely Griffiths Group has established itself as a leading small cap manager. Why move into mid-caps now?
You're right, Ali. Look, 20 years of running a small companies fund, we've had to say goodbye to many of the best performing small caps as they graduate into the mid-cap part of the market. And it's that IP that we're leaving behind that we really want to monetise for our investors in this fund. We've owned upwards of 50% of all the mid-cap names just in the last 5 or 6 years. So we've often got a lot of intel, a lot of history with these companies, regularly dating back right to IPO. So it's that kind of, that qualitative knowledge that we bring to the table and that competitive advantage coming from small caps and moving up, we really want to monetise for investors.
It's obviously quite a crowded space. There's a lot of mid-cap funds in Australia. What makes this fund different to its peers?
So I'd pull out first and foremost the fee structure. So we're actually launching this fund with a flat fee of 1.05% inclusive of GST and no performance fee. And we think it's very important to have a lean fee structure in this part of the market. It's such a high performing part of the market that, you know, we're really looking to give ourselves the best chance to deliver after fee outperformance, and a flat fee structure we think does that. In addition, we're also going to run quite tight capacity. We want to keep this fund small, flexible and nimble relative to its market opportunity, and we think that's the second leg to creating a differentiated outcome for investors in this part of the market.
Is there anything else that you think makes this fund different to its peers?
I would call out our style. Our investment style is style agnostic. And to be clear, that means that we're not anchored to either the growth or the value style. It means we remain flexible and able to change the portfolio when the data changes. And I guess to be able to deliver that kind of return profile or that style in portfolio, you need actually quite a broad capability set. So you need to be able to look at the GIC sectors of the benchmark and understand exactly what each is doing and manage to that benchmark risk. And that, to call out very clearly, resources is 25% of this part of the market. And if you don't have that capability, then it's very hard to outperform this part of the market. So I would call that a broad capability set, a diverse team, 7 in the investment team, and bringing that same discipline and investment style to this part of the market will give us the best chance of outperforming.
You talked to the outperformance in mid-caps over the long term. Why is that?
I think, Ali, if you look at it, there's a number of reasons. Really, it talks to the quality of these companies, the liquidity, the governance regime. These are more established businesses. They've often got high barriers to entry. They're profitable. Those kind of dynamics are very favourable. And you've also got just the dynamics of the best small cap companies as they graduate. You know, they're often on a momentum, a profit growth story that gives that real turbocharge as they enter the mid-cap part of the market. So over the very long term, that mid-cap part of the market does outperform. This fund's designed to outperform a benchmark that'll be a blend of 70% of that part of the market, the mids, with 30% of the small caps. And I think if you bring that benchmark together, what we're really looking to do is pull 2 pools of capital together. 20 of our best names in mid-caps complemented with the highest conviction 15 names from our small cap heritage. And I think building those 2 pools of capital together in one portfolio with that flat fee structure and a diverse capability really gives ourselves the best chance of delivering outperformance in this very compelling part of the market.
A lot of mid-cap funds have struggled to outperform that benchmark. Why do you think you can?
Well, I think particularly in the case of after fee outperformance, you know, that may well be the case. So, look, I think we'll talk to our diverse capability and our track record of managing benchmark risk, which we've done for 20 years in our small cap fund. So we want to bring that same discipline to this part of the market. To do that, you need to have a diverse capability set. And we talk about resources a lot, but if you look at this blended benchmark, we're looking to outperform. Upwards of 30% of that benchmark is basically resources and energy. And then if you add REITs on top of that, it's almost 40% of the total benchmark. So we actually think by default, many managers don't do a lot of that, you know, invest heavily in that part of the market. We've got a very long track record of adding value within resources, selectively when the time's right. And so we want to bring that capability to this fund, and we think that will be a point of difference.
Okay, what does that mean for your small cap thinking or your outlook on small caps? Does it mean, you know, going into mid caps, does that mean you feel like the outlook for small caps is challenged from here?
Small caps have underperformed very significantly in the last 12 to 18 months particularly, so I think it's fair to assume that you might see a mean reversion trade in the short term into small caps, and hopefully this portfolio will still be able to capture some of that.
Okay, corporate earnings have obviously been under pressure. What's the outlook for mid-caps from here? Can they still outperform with that in mind?
Yeah, look, clearly earnings are under pressure at the moment, but our strong view is that the Fed and inflation was a calendar 22 story. So what we're really focused on is just purely, as you point out, the earnings profile of these companies. And we think really high conviction bottom-up stock selection where we have a clear focus, particularly on a company's medium-term earnings profile, not just year one, but really looking into years 2 and year 3 is the backbone to what we do, and that's where we think we add value. And so that focus is absolutely paramount at the moment, given some economic weakness. But our portfolio is built with names that we have a high conviction in the earnings outlook over the medium to long term.
Let's dive into some of those names. What are your 2 highest conviction mid-cap stocks right now?
So look, car sales has been in the portfolio for some time. To be fair, it's a very consensus trade, but we do think Cameron McIntyre and the team have a fair bit of fat in that P&L in the sense they've really cushioned the earnings growth at that mid-teens EPS growth for the next couple of years, and we think that'll be very attractive in a market that has clearly some spongy earnings growth in pockets. So car sales is a very high conviction name. The other one I'd say is, and a good example of how we can monetize some of our small cap IP is in the case of Boral. Boral's a very high conviction name. It'll be in the top 5 in this new fund. Vic Bansal, the CEO there, we've got a long history with. We're really backing Vic to deliver a very focused, concerted, accountability-driven P&L at Boral, which is a very big change of the Boral of old. And so again, we think there's Boral had its earnings recession last year, weather, energy costs, construction disruptions. We really think the outlook for Boral's being driven by margin upside, new management that are extremely focused on the outlook.
On the other side of that, is there a mid-cap that you believe is headed for small cap territory from here?
So look, I wouldn't call out one stock, but what I would say as a sector, the lithium names have been a very hot place to invest for a long time. We were very early onto it in our small cap fund. They've all now graduated to mid caps, these names. You think of the Pilbars and the IGO and the Mineral Resources and so on. We actually see that sector as quite well owned, been quite a consensus trade that's under a lot of pressure at the moment. So we've launched our new fund with a big underweight to lithium. And we think certainly in the short term, the mark to market from the spot prices versus where market expectations are and versus the last 12 months will be a big headwind for the sector.
Is there a commodity that you prefer instead?
Look, we are long uranium. We believe there's a multi-year cycle unfolding with uranium, particularly. Spot prices $75 a pound, up from the low 20s only sort of 24 months ago. So we've got the early signals of a bull market unfolding within uranium. So we are very attracted to that sector. So we do own stocks like Paladin in this new mid-cap fund, which we believe are just about to commission the Langer Heinrich project and is well positioned to deliver good investment returns for investors.
Okay, David, last question for today. Are there any small caps that you believe are well on the path to becoming mid-caps or even large caps in the future?
Yeah, look, we refer to them as the next generation of mid-caps, and these are the stocks we're always looking for. It's that small cap stock that's on its way through, looking to graduate into the ASX 100 or that mid-cap part of the market. And I'd identify a stock called Genesis Minerals. This is a company that's a gold company that's been run by Raleigh Finlayson. Raleigh actually ran Saracen. He built that stock from a 40-cent sort of micro-cap all the way through the ASX 100 and then a merger with Northern Star. So we think the seeds have been sown for Genesis Minerals and its trajectory in the gold space, multi-assets, multi-facilities, production facilities, give it the infrastructure and the backbone to grow and scale into the ASX 100 over time. Look, I also mentioned Boral before. We think Boral's another example of a stock, again, that small cap stock coming through that this fund's going to look to really take advantage of.
Okay, well, thank you so much for your time, David. I really enjoyed this chat.
Good to chat, Ali. Thank you for having me.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.